Rajat Rajgarhia, Managing Director of Institutional Equities with Motilal Oswal Securities, joins us. Rajat, fantastic to have you back on ET Now. Thank you for joining us. Rajat, so let's talk about the moot point. And the moot point is that FDI limits in railways and defense has been hiked. From a market perspective, do you think this is a big move or this is only a sentimental booster and not a material booster?
Well, I think right now this is going to go down more as a measure of intent and not as a measure of material impact, because these are areas where we will have to see what kind of projects will come up, which companies from the international arena under what terms and conditions will look to enter these ventures. So I think these are something where the impact will be seen only over a long period of time. The more immediate measure that markets were looking forward to was from FDI and insurance, and which you, as you mentioned just right now, is something which definitely seems to be facing some roadblock. I think that is the key test for the government right now, to see how soon they are able to pass through this FDI and insurance. Railways and defense is something which, of course, is any such reform is good, but I don't think it is right now a game-changing event for the markets.
Rajat, let's talk about the market mood. And for the moment, the market mood is evident. We are not going anywhere.
Well, yeah, I think it's good that after the kind of move, 20% move between Jan and June, we are seeing the markets kind of consolidating very well. But I think what has taken everyone by surprise is again the change in the sectoral rotation, where a lot of the exporters, primarily pharma, technology, have been big performers over the last 2 months, and many of the domestic cyclicals have seen good moderation. I think generally the markets typically slackens from mid-July till August, and beginning September you start seeing a lot of action again happening back into the markets as many investors in the West return from their vacations and start positioning for the second half of the year. So I think in August we will see markets remaining range stuck. Good thing is that they are still holding on. They are not seeing any worthwhile correction for us to again come back into an action mode beginning of September again.
So what is it that you're recommending clients right now, Rajat, in terms of where the bias is?
Well, we think that after this whole top-down realignment of asset prices into many of the sectors playing out, you again have to refocus back on the earnings. And I think this quarter, the earnings trend at least have been reasonably good for most of the names. And if you just focus on the larger names itself, some of them primarily, starting from an Axis Bank to a Maruti, Tata Motors is yet to report. Some of the cement names have been showing good volume growth numbers. I think many of these names will continue to do quite well. On the other hand, you have some of the companies where the businesses are now going to either start recovering very sharp or there is some definite trigger to their numbers, primarily like stocks like ONGC, where we think that the net realization from a $40 last year will just keep on moving at least $10 higher every year. Some of these names can be big return stocks in the years to come.
So you think Axis Bank can still be a big return stock after a big rally this year? The stock is up more than 60% this year.
Well, if you look at just the current year, which is FY15 earnings, it is trading at 13 times current year earnings. And you are exiting the worst year of GDP growth as far as the economy is concerned. And they are entering this next up cycle with almost one of their highest capital levels. If they can compound their earnings at 20% over the next 3-4 years, you don't assume any re-rating. 13 times is of course the lower end of the band. You will still compound your money at 20%. But you will see doses of re-rating happening for the name. As 13 times moves up to 16, 17 times, I don't see why this stock should not be a big return from here over the years to come.
Rajat, jump in on that good old debate of PSU versus private banks. And for the longest time you've maintained that, look, you like private banks, but within PSU banks you support the idea of buying SBI. Why is that?
Well, I think most important is that within the domestic cyclicals, I think PSU banks are the deepest cyclicals, and when things go wrong, almost everything go wrong for them. Look at what has happened in the last 2 years. As the NPL cycle started building up, you had to reverse income, you can't book new income, you have to provide more. So everything got hit. But now, as the cycle starts looking better, you don't have to reverse income, you can start booking new income, you don't have to provide more, and you can start writing back some of the losses that you have already provided for. The ROAs from 1% has fallen down to 40-50 basis points. PNB was the first bank in the PSU pack this quarter to report a 1% ROA. Once these banks one by one start coming closer to that, I don't think everyone will hit 1% ROA, but even if they move from 40 basis points to a 70-80 basis points, that is going to be a big earnings cycle changing for them. SBI will lead that charge. So and we think that stocks like SBI, PNB are the ones which, even though they have rallied from their lows of March, they are still just at about their long-term average versus the earnings growth, which is only set to accelerate from here.
Rajat, just our info edge, some of these names, given that there is not much in terms of comparisons from a valuation perspective, you're giving a bit of a scarcity premium to these businesses. What's the view on these stocks?
Well, there seems to be a scarcity premium for these companies globally, where at least in India you have these companies which are still making profits. You have global companies which have $100 billion of market cap with hardly any profits there. But I think the moot point here is that this is one business where the growth is going to be in such a high variance that whichever companies are able to get their business model right, this will be a winner takes all kind of a theory. At least, and companies like Just Dial, who have been in this space for a long period of time, are going to are going to leverage this opportunity a lot more. InfoEdge again has been a classic case where they have built a brand for themselves in their own domain area. I think more important is that this is a market which in this next up cycle over the next 5-7 years will become very big. We will have new listings, and many of these listings may not be in India, maybe overseas also, but the benchmarks will be set. You have an Alibaba kind of a listing which is coming up, one of the most highlighted IPOs of this year. At least on the run up to that, I think you will see a fair bit of excitement happening into these names. But yes, one has to be prepared. Whenever you invest in such names, you should always be prepared that the volatility is going to be very high. Just Dial for itself corrected by almost 40% after you saw a similar correction in the global e-commerce place. But quickly it has recovered back. We think some of the winning models have a long way to go in this pack. Important is to figure out which are those. In India, there is only 2 which are listed, and that's why they are also getting that premium for that.
Yeah. Fair enough. I also wanted to ask you about the direct consumer stories, especially in HUL that we were discussing in yesterday's session. I mean, the stock has gained about 25% year to date, completely under the radar because this year we focused more on the cyclicals. What's the view on HUL, and are you recommending consumer names?
Well, within the consumer pack, I think as we have been articulating for a while now, we are moving more to the urban consumption pack. We are just redefining this consumer to a consumption pack where you need not limit yourself just to the staples part, but you can start focusing on where the additional wallet share is going to be spent to. So whether be it companies like Titan, be it companies like Maruti, Jubilant Foodwork, many of these names and a lot more new names that are going to be a part of our coverage over the months to come. That is the space which is going to be more exciting. As far as the staples are concerned, I think the growth rates will keep on mixing between rural and urban, and the rural definitely at this point of time should see some moderation compared to what we have seen in the urban over the last 3-4 years. HUL at least has been a surprise move where it has outperformed the markets, as you mentioned, 25% up for this year also. But considering that the earnings growth will be limited to the teens right now and the valuations are almost at 30 times, I think that fair bit of performance has already been captured into the stock by now.
But isn't that the case even with cyclicals? I mean, a lot of these infrastructure companies, oil and gas companies, I mean, they've had stupendous rallies year to date, pretty much factoring in the turn in the earnings cycle that may be expected a quarter down or 2 quarters down. So on a relative basis, while there is, from a valuation perspective, there perhaps might be more headroom in the cyclicals, but given the earnings visibility in consumer names, wouldn't there be a strong case to still be invested there?
Well, I think more important to understand here is that this round of the market move that we have seen, a 20% move from Jan till now, a lot of this market move is to realign the asset prices of the companies in wake of the higher risk that markets have been willing to associate with. Now, as I mentioned, wherever you will start getting more earnings comfort, that is the space that markets will start valuing more. And here we are not differentiating much between consumer and domestic cyclicals. You have to pick every stock on its own merit. As I mentioned, if you have a $40 net realization for ONGC last year, and considering the big fall in the under recoveries that has been happening, if this net realization moves from 40 to 70, 75 in the next couple of years, the 30 rupees earnings can well become 60 rupees earnings. And I don't think a 400 rupees stock price of ONGC factors that 60 rupees kind of a potential EPS that it may do. That is not the case with some of the consumer names, right? Where they cannot see that kind of a sensitivity to, they will be more steady state 12, 13, 14% earnings growth modes, right? So they will have their own phases to catch up on performance, but not necessarily a re-rating process that can come. So as and when you get that 13, 14%, then you will have to wait for the next year rollover to happen for these names.
M&M from the auto pack, Rajat, how are you dissecting the interest there between four-wheelers, two-wheelers, and then, of course, between four-wheelers, it's a divide between CVs as well as passenger vehicles.
Well, I think the top stocks right now are very clear, are Maruti and Tata Motors. Maruti, while the stock is at its all-time high, the volumes are at almost flat for the last 4 years. We think that over the next 3-4 years, when the volume moves from this 1.2 million to more closer to 2 million, the operating leverage along with stable currency can do wonders to the earnings and similar to the stock. Same is the case with Tata Motors. JLR continues to hold on well, but the domestic business, which has been the drag, will return back with a big bang over the years to come. That is not just a higher earnings, but also a higher valuation for the stock. M&M, I think they also reported the July month volumes where both UVs and tractors had shown a decline. At this point of time, it would definitely not be on the priority list because we will have to see through on at what point of time we start seeing both of these businesses. Generally, the stock will only do well when you will see both these units growing into double digits, and that is not happening anytime in the near future, which is why this is a stock which will right now, at this point of time, will lag Tata Motors and Maruti both.
Rajat, final question. Big money in a bull market is made when P and earnings, they both expand. Give me 1 or 2 stock ideas where you're confident of earning expansion and a P expansion.
Well, I'll give you the 2 large cap names where I think both earnings and P expansion will make will do very well to these names. So first is of course Axis Bank. The earning expansion is going to be quite good in an up cycle, and I think there is immense scope for a P expansion. And second, as I mentioned, is ONGC, where I think there could be wonders over the next 3-4 years as far as the earning. Suddenly everything can go right for them. And valuations we have seen is always just a function of how earnings growth come. So I would stick to these two large cap names where I think they can definitely be good return, big return stocks in this next cycle in the making.